During times of crisis, whether it's a global pandemic, economic recession, or political instability, many of us are faced with an important question: should we hold on to cash or invest? There's no one-size-fits-all answer, but understanding the benefits and drawbacks of each approach can help you make a smart decision. Let's dive into the considerations behind holding cash versus investing during a crisis. 1. The power of holding cash. Holding cash during a crisis can be a smart move for several reasons. For one, cash provides liquidity. In uncertain times, having cash on hand gives you the flexibility to deal with emergencies, cover living expenses, or seize investment opportunities when they arise. When the future is unpredictable, this kind of flexibility can be invaluable. Another key benefit is peace of mind. Cash acts as a safety net. Having enough saved in an emergency fund, typically 3 to 6 months worth of expenses, can help you sleep better at night, knowing you're prepared for whatever comes next. This sense of security can help you make more rational decisions and prevent panic-driven financial mistakes. However, the downside of holding cash is that it doesn't grow. In fact, with inflation, the purchasing power of cash can decrease over time. The longer you hold on to cash without investing, the more you risk losing out on potential gains from the stock market or other investments. Inflation can erode your savings, making cash less valuable in the future. 2. The case for investing during a crisis. While holding cash is about safety and flexibility, investing during a crisis is about capitalizing on opportunities. During market downturns, stock prices often fall dramatically. For long-term investors, this can present an opportunity to buy quality assets at a discount. Warren Buffett once said, "Be fearful when others are greedy and be greedy when others are fearful." If you're in a stable financial position, investing during a crisis can potentially lead to significant gains as markets recover. For instance, during the 2008 financial crisis and the 2020 COVID-19 pandemic, those who invested in the market at its lowest point eventually saw strong returns when the economy rebounded. Historical data shows that the stock market tends to recover over time, and investing during downturns can lead to solid long-term gains. But investing during a crisis comes with risks. If you don't have an emergency fund or a stable income, putting money into investments could leave you vulnerable if your situation changes. Investing should be done with caution and should ideally be reserved for money you don't need in the short term. 3. Finding the right balance. The smartest move for most people during a crisis is to find a balance between holding cash and investing. Here's a step-by-step approach. Build or maintain an emergency fund. Before investing, ensure you have a sufficient emergency fund in place, ideally 3 to 6 months worth of living expenses. This safety net will help you avoid having to sell investments during a downturn if you need cash. Invest what you can afford to lose, only invest money that you won't need for emergencies. Consider how stable your income is and what your financial obligations are. If you have extra cash after establishing your emergency fund, that's when you might consider investing. Diversify your investments. During a crisis, diversification is key. Spread your investments across different asset classes, such as stocks, bonds, and possibly even gold, to help reduce risk. Defensive stocks and government bonds can provide stability, while equities can offer growth potential during recovery. Focus on long-term goals. If you decide to invest, focus on the long term. Market volatility is to be expected during a crisis, but historical data shows that markets eventually recover. Avoid making decisions based on fear and keep your investment horizon in mind. Cash, investments, or both? Whether you should hold cash or invest during a crisis ultimately depends on your personal financial situation and risk tolerance. If you're worried about your job stability or don't have enough savings, it's wise to prioritize holding cash and building an emergency fund. On the other hand, If your finances are secure and you're comfortable with some risk, investing could be a great way to take advantage of lower prices and grow your wealth over time. In the end, a combination of both strategies is often the best move. Hold enough cash for security and peace of mind, while also investing for the future when opportunities present themselves. By finding this balance, you can navigate the uncertainty of a crisis while positioning yourself for long-term financial success. If you found this video insightful, don't forget to hit the like button and subscribe to our channel for more financial tips and strategies. Also, check out our video on Financial Survival Guide, How to Prepare for Crisis and War, linked in the description below for more advice on navigating tough economic times.